Okay, thank you everyone for joining this next session. For those of you who are on the session just before this one about fraud and scams, I hope that one didn't terrify you coming into this one. This one hopefully will be a little more lighthearted topic, but an important one nonetheless. So we are here to talk about the importance of long-term care. We're going to be talking about different types of policies, lots of information that we need to get out to the community to make sure that people are advising their clients in the most effective way and understanding how the long-term care industry has changed and what's ahead. So nobody better to explain it than our good friend Suzanne Shear, who is also we're very grateful a sponsor of this event. And Suzanne, we'd love to have you introduce yourself to the group and tell us a little bit about yourself.
Sure. Mark, thank you so much for having me, first of all, and for organizing this. This is such an important couple of days to be spending, whether it's spent live or watching on demand. I think it's just so important and so timely. So thank you for including me.
Of course.
So I'm Suzanne Shear. So in my first career, I did family law, and I help people going through really difficult times. And I ended up taking quite a long career break between raising my son and overseeing the care of my parents. Both had long illnesses, and I was the only child, and I was pretty young at the time because they were on the older side when they had me. So I experienced a sandwich generation starting in my 30s, so a lot younger than most. But when I finally was going back to work, I really wanted to help people in that scenario and try to help them. Unfortunately, can't help the fact of parents getting older or people having health issues, but if I can help with a financial piece to take off some of the stress, that's where I like to come in. And so I've really become, I would say, obsessed is fair, with long-term care insurance because I see how important it is and I see how few people are looking at it or thinking about it. It's a topic that's very easy to push aside because it's not pleasant, it's not sexy, it's not fun, and no one wants to think about it. But the difference that you can make for yourself and your family, both in, the emotional impact on your family and the choices that you can have later on in life, are just so profound that I feel compelled to, shout from the rooftops, whether it's literal or virtual, just to let people know that this exists, what it is, how it works. It's not right for everyone, but everyone should know about it and at least go through the exercise of figuring out, okay, does this make sense or not? And if it doesn't make sense, I'll be the first one to say it. But just letting people know the importance of it and trying to make it easy as possible to understand and make the process as painless as possible. So that's where I'm coming
Yeah.
from.
Well, and it's so important because we see, we help clients navigate the financial side, but usually it's either in tandem with an LTC policy or it's to try to make up for not having one.
Right,
And so when you don't have those policies in place, what it does, it puts more pressure on you in other ways.
right.
And that could be from needing to borrow money, it could be needing to pull money from investments more rapidly than you would normally want to do that. But the cost of care has gone, through the roof. We're all professionals
Absolutely.
here. We've all seen it.
Right.
It could be 20, 30, $40,000 a month. You add that up over time, that's pretty substantial. So,
Right.
do you usually see that when families are planning that they're usually trying to figure out more than one component to pay for their care in the future, like a mortgage, long-term care insurance, VA benefits, whatever it may be, where they're almost like stacking things to be able to get to pay for it in full?
Right. I think when people are doing the best possible planning, then I think yes, I agree that that's happening. They're looking at what sources of income will they have, for the folks who are lucky enough to still have pensions. There are a few out there, not a lot, but the folks who have
Right.
pensions, um, the
Those will
folks
probably go
already,
with this generation that's aging.
I know,
I'm
I
not sure if
know.
my generation will even know what a pension is.
I know. But anyway, so for the lucky few who have those, or, for those who have Social Security, which again, we don't know what's going to be with that. But for those who have these guaranteed sources of income, and then pairing with their assets they already have and figuring out, what's a sensible plan, because to get a long-term care policy that would cover every penny of care is cost prohibitive. And it doesn't really make sense because there are some lucky people who never need care. So there are a lot of different statistics that you'll see. There's one out there that says 70% of people over 65 will need at least some kind of care. But that statistic is a little bit misleading because that includes not only the activities of daily living that are counted for purposes of long-term care, but it also talks about the instrumental activities of daily living, which are things like balancing a checkbook and going grocery shopping. And those are not things that are technically triggers for long-term care. So the real number that I work with usually is around 56% of people are going to need some kind of care. And so I view it as a hedge, having a long-term care policy and looking at how can you work this in concert with your other assets so that you not only don't have to take all the money from your own assets, but also so you have some choice. So like you were talking about depleting assets, if you have a care need that happens when the market's down and you need to start taking money out at an inopportune time, I'm sure you're familiar with sequence of return risk, but that can have a very bad impact on your future if you're having to draw it at a bad time. And so if you know that you've got money in a long-term care policy that's separate from your other assets, that's something you could draw on. Maybe decide, okay, well, the market's down now, so I'm going to lean more on the long-term care policy. And then when the market's stronger, maybe I'll lean more on the portfolio. But it just
Right.
increases the flexibility, which is
Yeah,
incredibly
you brought
important.
up a great point. This actually came up on one of our prior sessions. I think it was called Financially Preparing for Aging.
Mhm.
And the gentleman who was talking about it was saying you need to have diversification so that you can have a choice of
Mhm.
where to pull the money from, because it
Right,
might be better to pull it from one source than another at one
right,
point in time, and then that might completely flip later,
right.
if the market turns around or whatever it may be. So
Right,
just having
right.
those options is really,
Absolutely.
really critical.
Absolutely.
So glad to
Absolutely.
hear we have consistent messages from one session to the next.
Yes, definitely.
Um, and I think there's also a lot of confusion, or just people just aren't aware of how long-term care policies have evolved. So maybe you can give just, top level, not getting into too much detail, but just kind of top
Hmm.
level what types of policies there are and
Sure.
why somebody, a family, or an individual might choose one over another.
Great question. So the two main types of long-term care insurance are traditional or standalone. And then the newer kinds, newer not meaning brand new, but past maybe 20-ish, 20, 30 years or so, are referred to as either hybrid or asset-based or linked benefit. So the traditional policy is what's been around forever. And that is just a single bucket of money. And you determine when you get your policy, how much can you take out every month and how long is that bucket going to last? So it typically will add on inflation protection. So you might start off with a benefit of 4,000 or 5,000 a month when you get the policy. But the idea is that you'll have maybe 3% compound inflation protection so that the benefit amount and the pool will both grow over time. It won't quite keep up with inflation because the inflation on the health expenses and the care is a little bit higher than on typical expenses, but you want to do the best you can to try to keep up somewhat.
Right.
Um,
Maybe mirror it with gas prices. You'll be
oh
better
my
off.
God. Ugh.
Anyway,
Um,
sorry to digress.
no problem. So with the traditional policy, it's a bill that you're paying typically your whole life. So you get a policy, you're going to keep paying premiums until you either start using it if you need care or you pass away. So you're looking at just a bill that's going to be ongoing. And if you never need any care, there's not a cash value, there's no death benefit. So people complain and they say, oh, it's use it or lose it. Well, every kind of insurance is like that. I mean, term insurance, car insurance, homeowners. I mean, all the other types of insurance are like that, but no one complains. But in this area, people don't like that. Um, the good thing about it is that you get the most bang for your buck. So you're putting the least amount of dollars and getting the most amount of coverage. And from day one, once you get a policy, you get this huge amount of leverage. So it's typical, insurance, you're transferring the risk of something catastrophic happening. So you put in a small amount of money, you have a big pool of benefits available to you if you need it.
Right. And
So
sorry to interject here, but one
no,
question I have is you don't have to be a senior, so to speak, or elderly in order to make a claim on a long-term care policy, right?
Exactly
So if you
right.
had some health event or I don't know, maybe an accident, I don't know if that would apply here, but some type of event, we had a client we were talking to about getting a mortgage. He had a stroke at 62,
Oh, wow.
and basically was going to need full-time care for the rest of his life
Oh, wow.
because of it. So,
Hmm.
are those situations covered by these policies?
Yes, exactly. Let me talk back up a little bit and just explain what's covered. And then, yes, you're exactly right. It could be at any age. There's no age. People think that, oh, this is for end of life, or this is for elderly people, or that there's some age, but there's no age requirement. What they need to have in place is if you can't do 2 out of 6 of the activities of daily living. So those are, if you think about what you did this morning to get ready for your day, you transferred, you got out of bed, you went to the bathroom, took a shower, got dressed, ate, and then during the day, you're maintaining continence. Those are the 6 activities of daily living, or ADLs. If you can't safely do 2 out of 6 of those, or if you have a significant cognitive impairment, and whatever is causing this scenario is expected to last at least 90 days, then that's considered a long-term care event. So people have an image in their head, oh, I'm bedridden and I'm on my deathbed and it's just so terrible. It could be somebody went skiing and they broke their legs and an arm, and they don't either, they're maybe, let's say it's a guy who's 6'2", 300 pounds, and his wife is, 5 foot, 2 with 100 pounds, and just, can't help him. And so they need to hire somebody to care for him. He could be healthy otherwise, but he's just injured. And so it's going to take maybe 4 months to heal. He could he could trigger a long-term care policy and have a benefit. Or if somebody has any other kind of car accident or illness, it doesn't have to be a long-term. It just doesn't have to be a permanent illness. It just means just something that's expected to last at least 90 days. It's like a hose you can turn on and off. You just turn it on, get the benefits, and then when you're recovered, you turn it off and save it for later. Now, most policies will have what's called an elimination period, but that varies based on the policy. So a lot of times it'll be in 90 days. So you trigger a claim and you have to wait to start collecting the money from the long-term care policy, but some have 0 day for home care. One policy has 0 day at all, no elimination. So that varies, but you're exactly right that at any age, as long as your policy is in force, your age is irrelevant. It just all has to do with whether or not you trigger a claim based on what's the requirements are that I mentioned.
Right. And questions just keep popping into my head, so I'm just going to fire them
Okay,
off because I want this
sure.
to be conversational. But is it kind of similar to, let's say, homeowners insurance or car insurance, where if you have a claim, it somehow works against you, where your premiums may go up after that?
No, no, great question. No, with traditional policies, the way that they do increases is if everyone in your same cohort, like let's say they take it by county or state or age group, or they find some kind of a cohort and they say, okay, well, people in this cohort are all going to get an increase. They have to go to the state insurance commissioner and be approved. But let's say the claims experience is such that they need more money to cover claims. They can apply to the state insurance commissioner and say, everybody who got a policy at this time, or everybody who's this age, or everyone who's in this county or this state, and they apply based on this group, and then they get a permission or not to make an increase. So you're not adversely impacted by putting a claim in. The other thing that's sort of related to that is that with the traditional policies, the premiums are not guaranteed level. So they do increase over time, but you just don't know when or how much. Um, One thing, a sneak peek on the hybrids, one thing that's really nice with those is that those have locked in premiums, so they can't increase. But I'll talk about that in a second.
Yeah, so you're more in control. Okay. Yeah, I mean it,
Um,
and it's more like the use it or lose it, as you said, type of
Well,
policy.
the
Yeah, the
traditional
traditional, right.
is. But then
Right.
with the hybrids, people didn't like that use it or lose it. And so they said, okay, well, let's have 2 buckets of money instead of 1 bucket of money. And typically the first bucket is an insurance policy. And then connected to that is a second bucket of money that's an extension of benefits. And the way this works is you purchase the policy, you've got your first bucket is your insurance policy. And if you need care, that's where the money comes from first. If that is depleted, then they go to the second bucket of money, which is just an extension of benefits without a death benefit to it. So let's say someone has a really significant event, they'll go through the first bucket and then they go through the second bucket until that runs out. If if you don't ever need any care, then the money that's in the insurance bucket goes to your beneficiaries tax-free when you pass away. Now that money, that insurance policy, depending on how you structure your policy, it could be more than what you paid in, could be less, could be, it really varies. But the idea is it's a way to get a tax-free return of premium if you never need any care. So it takes away that use it or lose it component. And, people have the objection, well, I'm never going to need care. I'm going to be perfectly fine. My neighbor might need it. And this neighbor, my neighbors on both sides might need it. And the statistics might say that I'm going to need it, but I'm never going to need it.
Right.
So for those people, it's kind of a helpful thing because they know that the money will go to their, at least go to their beneficiaries. It won't just
Is
be
the
flushed.
degree to which you're stubborn part of the underwriting process? Because
Oh
that
my
seems
gosh.
like I'm thinking of my own family and be like, yeah, that sounds like something that would come out of my own
Right? It
family.
should be.
Exactly.
Definitely should
So,
be.
okay, so there's two different components to the hybrid policies. Does that make them, if you look at the premiums at the same moment of time, same health
Uh-huh.
conditions, are the hybrids more expensive or less expensive or about the same?
Well, it's funny. I mean, it's typically more expensive, but the thing with the hybrids that's really interesting is that you have all these different ways of paying. So you could write one check and be done. You can pay over 5 years, 10 years, 20 years. You can transfer money from an IRA. You can transfer money from cash value from a life insurance policy. You can do all different kinds of things to fund it. And but the premiums, typically it's over just a fixed period of time. So it's difficult to compare it exactly because with a traditional, you can see what a monthly payment would be compared to the monthly payment on a hybrid, but you have no idea how long you're going to be paying in on the traditional. I mean, if you
Right.
lived to 100 and never need any care and you get it when you're 50, 50 years of premiums, probably going to be more than the cost of the hybrid.
Right.
But, if you look at it, if someone went on claim very soon, they would pay in less money most likely with a traditional. But
Right.
because you don't know, if you want to have a situation where you know exactly what your payments will be, then the hybrid's really nice because it's everything's laid out for you. You know what you're going to pay, what will come back if you don't need it, what the benefit's going to be at various points in time.
Right. And
Um,
you're subject, if you do the traditional policies, then you're subject to the insurance commissioner's decisions on whether they allow the
right,
insurance company to raise your rates and by how much.
right, and you never
Yeah.
know when it's going to happen. I mean, my mother-in-law has a policy that just happened to have the way hers works, it doesn't have the inflation protection act going into effect every year. Basically, every 3 years, you have the opportunity to buy more coverage, to
Hmm.
increase your amount. And her most recent opportunity for that coincided with a rate increase. So she was paying, I think, $700 a month. And then it went to 900. But then if you wanted to accept the additional coverage, it would go from 700 a month to 1400 a month.
Wow.
And then the next, I don't know, 4 years, it's going to go up another 20% every year after that. So,
Right.
as
And
you
so
get
that was a
older,
traditional policy, I would imagine.
right.
Yeah.
Yes, yes. So, and that one is tricky too because it pays less for home care than it does for facility care.
Hmm.
The older policies were not uniform, and so there you find policies like that where they don't necessarily pay the same amount for every type of care, whereas the current policies have to all pay for everything at the same level.
Is that because of more regulation? Like
Hmm.
the regulators are forcing that to happen?
Right. They put it into place that it needed to be uniform. Because I mean, if you look at old policies, it's sort of the Wild West. They were all over the place as far as what would be covered. And it was very confusing for people
Yeah.
because they never really knew what they had.
Well, and it sounds like there's a lot that goes into how a family might decide. Obviously, cost is one of them. I would imagine, correct me if I'm wrong, right now it's probably, I mean, this is a tough topic to have conversations with people, and I'm sure
Yes.
people are like, "Oh, I'll think about it later." It's one of those things. I'll
Yes.
kick the can down the road, no problem. I'll
Right.
deal with it later. But also, do you think that all the inflationary pressures that are happening right now, are you seeing clients either take cheaper policies because of all the other expenses that they're facing right now, or maybe kicking the can down the road even further than I mean, of course, they should never kick the can down the road at all,
Oh,
but maybe
right.
doing that more because of the inflationary pressures on gas and food and everything
Right,
else.
right. I think they're putting it off. I do agree they're putting it off more
Yeah.
and less, less willing to even consider it because of all the uncertainty and the increases right. When you see
Yeah.
how much it costs to fill your tank and to go to the store and go to the grocery store and all the things, I think people are
Right.
nervous for
And
sure.
there's only so much to go around, so you got to decide where your priorities are,
Right,
you know.
right.
But I guess if you don't eat and you don't do things that will keep you healthy, then you can make a claim on your insurance policy. So it all evens out.
Oh,
Not that that's the
gosh.
advice.
No,
Please don't
no.
take that advice. That's purely just a joke, of course. But
Yes, of course.
okay. And so when you're working with a family trying to figure out what does that look like? How do you navigate all of those different nuances to help a family decide? Do you usually give them options to choose from? I mean, it sounds like there's so many choices and it seems like little add-ons that you can do or different
Hmm.
things you can do that maybe would change the premium a little bit here, a little bit there.
Oh,
But how does
definitely.
that process look?
Well, one thing that's really important that I haven't mentioned yet is that the way that you can qualify for a policy is that your health has to be pretty good. It doesn't
Mhm.
have to be perfect, but it has to be pretty good. But I find out what someone's health situation is first. And if they have anything going on that's out of the ordinary, then what I do is I contact my insurance broker and I say, here's a scenario. I give it the anonymous, I don't give their name. I just say, here's a profile of this person, here's their date of birth. They take this medicine, they have this condition, or they had this, whatever their situation is. I give the details and they send that anonymously to all the different insurance companies. And then they'll come back with a tentative yay or nay as to whether or not they think they would get coverage. And that often limits it for us because if someone has a really complicated medical history or something out of the ordinary, then I might have a limit that way. So that's that can drive the conversation in that scenario. If there's a scenario where somebody is perfectly healthy, then I would just show them traditional and asset based and find out what's important to them. I mean, because each policy has its own kind of special features. I mean, there's one company that has an unlimited benefit, for example, in the hybrid space. So if somebody knows that they have a family history of dementia or the family history of, longevity, that they're really worried about, running out of money and they want to make sure they have a long benefit, that might be something that we look at. If somebody has inherited an IRA and they want to use that to fund it, there's one company that will accept that. If they care about being able to pay a family member who isn't a licensed caregiver, there's some companies that offer that option now. So I try to figure out what are the things that really matter to them. And, sometimes it's a deal breaker, sometimes they're flexible, it varies. But if there are any of those things that are important to them, then that will help steer it. But if that's not the case, a lot of times we'll look at price, we'll look at, what can they afford to spend? Because you don't want to make someone insurance poor, right? You don't want to
Right,
tie up so much money that it's not sustainable to pay the premiums. But
right.
and figuring out if they're a business owner because there can be some deductions for business owners because it's
Well,
treated
and
like
there's
health
also,
insurance.
yeah, some of the ways, I mean, we talk a lot about this event at collaborating and breaking down silos and things like that. So we've had situations where clients came to us and they were doing a loan, they didn't have a policy. And we uncovered that because we ask a lot of deeper dive questions. We're not,
Uh-huh.
your average transactional mortgage company. So we're asking questions to dive in to say, do you have a policy? Do you have a financial advisor? Do you have all these things? Not that we're going to take that role. That's way beyond our scope and
Right.
license to do that. But we did come across some people that did not have policies that really probably needed them. And they actually they were cashing out money to pay for, whatever they needed. And it became clear through a discussion with their financial advisor that it would make sense for them to cash out enough money to buy that policy in full. And so sometimes you can have collaborations between different professionals to be able
Right.
to come to that right,
Uh-huh.
conclusion. Uh,
Right.
So lean
Absolutely.
on your network. It's a big network and navigate. There's a reason we named it
Oh,
that.
right. Of course.
And you can
Absolutely.
lean on other people to help make those decisions. Plus, you have the financial advisory background as well, which is,
Right.
not everybody has. So I think you come at these things with a much broader perspective than just the insurance piece of it, which
Right.
is
Thank
important,
you.
but obviously there's more to that.
Right. Thank you.
Um, okay, so what do you see when, let's say you have a client who already has a policy and they're at the point where they may need to start claims, but the amount that they are eligible for is not sufficient to cover their actual cost of care, and they're concerned about, how am I going to afford whatever it is, home care, assisted
Hmm.
living. I'm X number of $1,000s a month short. Do those conversations ever come up, and what sort of solutions do you usually recommend that they look into?
I mean, it really depends on where the person is in terms of their health, in terms of their age, their financial situation. Um, if they're close to needing care, they might be limited. Really, it depends. I mean, if somebody already needs care, then it's usually too late to do anything for that. But
Right.
if their health is still halfway decent, there might be some options that could
You're
come
talking about
up.
on the insurance side.
Right, right,
Got it. So I'm sorry.
right.
My
Oh,
question
oh,
is more
oh,
about like
like
when you've kind of
having to
maxed
do.
out what you can do from
Oh, okay.
insurance, or maybe you're past the point where you can
Uh-huh.
qualify for additional benefit.
Oh, got
Are there
it.
other sources or resources that you've kind of helped people with that whole stacking that we were talking
Oh,
about?
right. Um, if it's not from an insurance standpoint, it really depends on their scenario and checking to make sure if they served in the military, like you mentioned earlier, if they were in the military, figuring out do they have any kind of benefits there. Um, if they're close to the point of almost going through all their assets, then Medicaid planning potentially they can talk to an elder planning or elder law attorney to see whether that might be something to think about.
Right.
um, just bringing in other professionals to try to see, what benefits are out there. But it's so case by case that it's hard to say,
Yeah. I mean,
for
we all
everyone.
know every professional that's on the call knows
Right, right,
situations never look the same.
right.
They never
Very,
look
very
the same.
true.
Um, so how would you say the insurers have adapted over time, other than creating the hybrid option, which I know was not brand new, but a while back. But are you seeing
Right.
insurance companies get tighter? Are you seeing them get more creative? Like, what do you see behind the curtain?
Well, one thing that I'm really excited about is in October of last year, Nationwide came out with a new product. Now, they're not the only one to have this, but it is still an asset-based, hybrid. So it's got the two buckets of money, but instead of the first bucket being an insurance policy, the first bucket is an annuity. And so you have to put a lump sum into it. But the thing that's really nice about this particular plan is that they only ask a minimal number of medical questions, and the underwriting is way more lenient than it is even with the asset. So the traditional is the most strict with underwriting, and then the hybrid is more lenient because you're using a bunch of your own money to pay, and so they can be more lenient. But this annuity base is even more lenient. I've been able to get policies for folks with autoimmune disorders, which usually they can't get coverage. So that is something that is it's a kind of a game changer because for folks who weren't able to get coverage, you can all of a sudden now have this option where it's an indemnity policy, meaning you can get just cash and pay whoever you want for care. And it's a really nice, easy, simple benefit, but you basically just have to check off some boxes, and they just check medical record, or they don't check medical records. They check prescription records and your diagnosis codes, but they don't do a phone interview. They don't do a medical interview. They don't get medical records. So it's opening up the door for a lot of people who otherwise were not able to get coverage. And um,
Yeah.
it's been, so that's really exciting to me because, I hate to tell somebody, I'm sorry, I don't have anything for you. There's nothing that we can do for you. And so to have an option, there are some others in that space, but they're kind of confusing. And I feel like if I deal with this every day and I'm confused by a policy, I can only
Yeah, the rest
imagine
of us are in
someone,
trouble.
right? No, really. I mean, I
Yeah.
like simple. I don't like too many moving parts because I just think
Yeah.
it's too complicated.
Yeah. And there's a question we just got in the chat
Hmm.
from Skip. Thank you, Skip. Hi, Skip. How are you? Do you ever see partnership policies coming back? Now, I don't know what a partnership policy
Oh,
is,
okay,
so
I'll
maybe you can
explain.
start
Of
there.
course. So in the traditional space, that's a great question, Skip. Thank you. There's something really neat in most states, not every single state, but most states have something called partnership, which is a partnership between the insurance company and the state Medicaid agency. What happens is if you get a traditional policy and you add inflation protection to it, and if your state is eligible, you can have this policy where it has a partnership provision. And what that means is if you, let's say somebody has a policy, they go on claim and they use their whole policy, let's say it's a $300,000 benefit for care. The person uses that whole benefit and they still need care. They can apply for Medicaid, and instead of having to spend their assets down to $2,000, they can preserve an equivalent amount of assets to what was paid out by the long-term care policy. So they can shield 300,000 of their assets from a spend down requirement.
Oh, wow.
So it was put into place to encourage people to get long-term care policies because the Medicaid agencies are just so swamped with people who need help. And they were trying to figure out a way to give an incentive to people to get a long-term care policy. So that's only with the traditional policies and only in the states that allow it. Most states provide for it, but it's definitely something that most people don't really think about. I mean, I don't talk about it a lot because, I'll get to that one in a second. That's sort of it's it's kind of an esoteric thing, and so a lot of times people they already glaze over enough with all the different facts so that it's a little bit much.
Yeah.
And Skip also asked with Washington State. Washington State a few years ago put into place this provision that said if you don't have your own private long-term care insurance policy, we're going to tax your income point, and it's like 0.054% of your income without any kind of limit. And that's to go towards the Washington Cares program, which is a long-term care benefit. But when they first came out with it, they said the lifetime benefit that you could get for long-term care was $36,000,
Ugh.
which doesn't pay for
That might
very
be one
much,
month.
depending
Thanks a
where you
lot.
are, right?
Yeah.
And so,
I'm from
so,
Washington originally, so I'm a little embarrassed by that.
um,
Not
but
going to get you very far.
so there was this huge rush of people going to get long-term care policies because they didn't want to be subject to this because there was a certain time frame where you had to get a policy in order to be exempt from that law. So a lot
Right.
of states are looking at doing something similar. So to the extent that it gets more people shopping for long-term care policies, that makes me happy. But I just worry that it's taxing people for something where the benefit is not very meaningful.
Right. Okay. And so looking at this from the business perspective and people who are navigating, we talk a lot about in this event about pairing yourself up with really good professionals and having
Hmm.
improving your network slowly over time and really spending time and energy on doing that, even if it's not a immediate source of referrals or anything like
Uh-huh.
that. But what would you say differentiates one long-term care insurance, like a good one from a average one? Like what separates people in your space?
Great questions. One thing that's extremely important is that the agent should know what the person find out about the prospect's health in enough detail to figure out whether or not there's something going on that would cause them to be declined or that would warrant waiting to apply. As an example, if someone's in physical therapy and they apply for long-term care insurance, they're going to either be declined or postponed. So if the agent, I mean, I hate to bash financial advisors since I'm one, but let's say you're a financial advisor and you dabble in long-term care insurance and you just take an application for long-term care from your client without finding out enough about their health. If you don't know that they're in physical therapy and they don't volunteer it, you could apply and they could get declined. And then they could either not be able to get it at all or they might have to wait to reapply. And so it's really important to do the work on the front end to figure out, what is someone's health, medicines they take, any conditions. Now, sometimes clients don't tell you and you can't do anything about that. But if you ask and they don't tell you, that's unfortunate. But you have to
Yeah.
at least try to find out as much as you can about their health situation. So I would say that's the number one thing.
Right.
And
And sorry to
then, yeah.
interject really quickly. If it comes up, like let's say they get declined by one insurance company and then they want to apply for a different insurance company, can the second insurance company see why the first one declined or that they even applied?
Um, I mean, typically, yes, they can see that. Or, I mean, some companies will still consider, but some won't. So
Okay.
um, it's very dependent on the company.
Got
So
it.
you want to avoid that at all costs. To the extent that
Right.
you can do the work on the front end, you want to try that. Another thing that I think is really important is working with somebody who specializes as opposed to, like I said, dabbles in it. There's so many different little nuances and so many features to the different policies, and they're always changing. And so when I look back to when I was starting, at what I knew then compared to what I know now, I mean, it's kind of upsetting when I think about, you're right. Like I got myself a policy without doing as much research as I should have done, right? And I know things were different when I got it. This was maybe 9 years ago, but working with somebody who spends most of their time in this space, and so they know a lot of the different features, if so that way when I'm working with a client, I can identify the things that are important to them and then say, okay, well, if you really care about not having an elimination period, then you should go with this company. Or if you really care about the unlimited benefit, or if you care about being able to use money from an inherited IRA or from an IRA, like, just being able to know about all the different options and really customize a plan to meet the needs. If someone's a business owner, figuring out, okay, what makes sense for being able to deduct some premiums. And
Right.
so I'd say basically that knowing the health information, and then someone who really specializes versus dabbles, I would say would be the biggest things.
Yeah. Well, as you're talking, I'm thinking of all the similarities between what you do and what I do.
Uh-huh.
It's not the same product, but it's a lot of the same, should we do this type of loan, that type of loan? What makes the
Uh-huh.
most sense? How do we find the right solution for the client?
Right.
Very, very
Right.
simple.
Yeah. So
And
funny.
the analogy I always use, which I think is what you're getting at, is because I grew up playing the drums. I'm a musician at heart. Is it's you have the instrument itself can't play itself, right? So the instrument might be the insurance companies, the lineup of different products that you
Uh-huh.
have, and whatnot, but it's not that's not what makes the music, so to speak. It's the musician behind the instrument that
Uh-huh.
you if you put me in front of a guitar, not a good idea. I can't sing. Don't even ask me to try.
Right.
Um, but it's the skills that you develop over time to be able to play that instrument or to work in your craft. And I'm sure everybody
Uh-huh.
on this call can relate to that. It's really how you do your job. It's not just having the products. Products
Right.
don't do anything by themselves. It's how you
Great
utilize the
point.
products and the
Right.
tools in your tool belt, so to speak, and the experience that you
Right.
have that really kind of
Right.
make beautiful music, whether that be
Right.
in insurance or mortgages or
No, that's a
rock and
great
roll.
point. Great
Yeah.
point.
So, okay. So, as far as aligning with other professionals, who do you typically find that the most synergy with? Is it other financial advisors? Is it like what other professionals do you think, if they don't have one already, need to contact you or someone in your space that can do policies in the areas that they're in?
I would say financial advisors who either don't do insurance or don't want to do insurance
Mhm.
be a great fit. Um, I know people might have a concern about the fact that I'm a financial advisor, but I can assure you that my goal is to build my insurance practice. I'm not looking to gain more advising clients. So if they're concerned that I'm an advisor and that they might, hopefully once they get to know me, they'll know that I'm not the kind of person to do this anyway, but I'm not looking to take the client, and try to poach the client. I just am looking to be the outsourced insurance. They're like an outside insurance department to help them get that part of it done and to partner with them and to make them look good and help their client. So I would say financial advisors, estate planning and elder law attorneys, CPAs, pretty much anyone who's looking, to help people get coverage in place. If it's the right thing, it's not right for everybody. Some
Right.
people, if they don't have enough money to pay the premiums, then it's a non-starter. That's not, so we're talking about folks who, have assets that they're looking to protect. And that if they did have a care event, that they would, find themselves having to dip into their own money, and they don't want to do that. They'd rather take advantage of the leverage that they get. And then the fact that, benefits come out tax-free, just the efficiency of it.
Sure.
So
You
I'd
have
say
to have
there's a
some
pretty big
means in order
range.
to be able to get there.
Right, which is kind of unfortunate because the people who really need this can't afford it,
Right.
right? And they end up on Medicaid without much choice. But for the folks who are really wealthy and are told, oh, you can just self-fund, they really can benefit the most because, I mean, some of the numbers are wild when you look at them. For somebody who has, could buy someone could buy the nursing home, they're probably not going to be even talking to me, right? But
Right.
but for folks who are high net worth, but they just care about leaving money to their children or grandchildren or a charity, or they just don't like to pay full price for things. I mean, I don't know about you. I don't like to pay full price for things.
Sure.
I was brought up that way. I just, that you just try to get a good value. And so if I can pay in, X dollars and the insurance company will back, 5 times leverage, 10 times leverage on my money, if I need care, I'm willing to give up the opportunity cost of the growth on the money in exchange for something that's a guarantee if I need care to have, many multiples of what I put in.
Right.
So,
Yeah. Again, another similarity. Because we work
right.
with families sometimes and there's two buckets. There's the people who are affluent where they're maybe making a business decision of sorts to take a loan,
Uh-huh.
where they don't quote unquote need a loan, but it makes
Right.
more sense to do a loan and not liquidate investments. And then you
Mm-hmm.
have families who have maybe depleted whatever their resources are and they have to take a loan in order to pay for
Right.
care or sell the home. And we have had sessions about,
Right. The capital
capital gains
gains.
tax and all those
Right.
things that they have to be mindful of.
Right.
I hope
Right.
they even have the advisors around them to be mindful of
Right.
those
I
things,
know
but
exactly.
it's
That's
very
funny.
similar.
That's
Yeah.
so funny.
We almost do the same thing, Suzanne, almost.
Yes. Except
Just
I'm more
different
of a nut.
instrument.
Being obsessed with mortgages seems a lot more normal than than what I'm
I don't
obsessed with.
know. I don't know. My wife wouldn't think so, but
So
it keeps the lights on.
yes.
And so where do you see the industry in the future? Like what do you think is still evolving? How do you think things will change? What sort of trends are you starting to see like the little buds of change starting in?
One thing that's really interesting, for a long time, they were offering workplace benefits where you could get long-term care insurance through your employer. And that sort of fell out of favor for a while, and that's making a comeback. And so I'm hoping that we'll continue to see more and more options where workplaces will offer coverage. I mean, there's a ripple effect. People are seeing what's happening to their employees having to provide care for family members, and I don't know if that will have any impact on the employers or not, but just
Right.
having more and more good benefits available, for the group plans. I think if folks can appreciate all the different opportunities, I mean, I could go on forever about all the different kind of funny planning opportunities we have using annuities or using different sources. The government has provided a lot of different tax benefits and incentives for people to get long-term care. And so I'm hoping that as people get more aware of it and, more of the professionals become, like, there are accountants and advisors who don't know some of these little tricks that we have for, it's more so a tax play than anything, but all the different ways that they're out there to make the best out of the situation of needing care so that do the least harm to your portfolio. So I think, maybe ideally the government will come up with more benefits for caregivers, or they will, I don't know. I wish they would do more to expand the amount you can deduct of your premiums, maybe make more a bigger part of the premium deductible, because right now it's a pretty small amount for a lot of people.
Well, and you'd think they'd be incentivized to not want to put too many people through the Medicare system,
Medicaid.
or I'm sorry, Medicaid
Uh-huh.
system
Yeah.
to where they would incentivize people to have their own private policies
Right.
in any way they can. So that
Right.
makes a
Right.
lot of
Right.
sense.
Well, the
We have a
states are different.
question
Okay.
from Daniel. Hi, Daniel. Nice to see you on here. In what year did long-term care place a cap on the care? And does long-term care cap at 4 years?
Um, I don't know the answer to the first one. I do know that the older, for the longest time, the traditional policies, when they first came out, they had unlimited benefits. They basically what happened when the long-term care policies first came out, the actuaries got it wrong. They thought a lot of people were going to let their policies lapse. They thought interest rates were going to stay high, and they didn't account for people living so long. So they came out with these really rich benefits for very low cost.
Yeah, I've heard
And
of them referred to as the Cadillac policies.
right, exactly.
Yeah,
And so people kept them because they were so good. So maybe 1% let them lapse so that when it came time for claims, that's when the increases really started to get, more and more and more because they didn't have enough money to cover the claims for all these people. So um,
right.
for the most part, you're not going to see unlimited benefits anymore, except for the one company I mentioned that has it in the asset-based or the hybrid space. Um, there's a big variance as far as how much, the policies go anywhere from 3 to 8 years in benefits. And then, like I said, there's one that has unlimited, but so it really varies by company. And that's another thing that, sometimes people say, oh, I'm not going to need that much, or I really want to get as much as I can get because my parent lived until 100, or they needed this much care, that much care. So
Right.
it's a big range.
Got it. Great answer. Okay. We're starting to get to the end of our session here. So, any final thoughts you want to share? And if not, maybe just how can people find you, obviously outside of the hub of
Oh,
speakers and
sure.
sponsors, but
Um,
any final thoughts that you want to share that we haven't
sure.
covered yet?
Sure. So I know that we're going to be talking about this in our session later this afternoon about reframing the conversation, but I would just urge people, if you have not ever looked into long-term care insurance, don't believe what you hear when people say, "Oh, it's a scam or it's evil." When I go on Facebook groups, I see these conversations when someone will post and say, "Should I get long-term care insurance?" And I mean, it's just such a polarizing topic, and people have such strong opinions, and it's usually based on outdated information. Like, well, my father had a policy and it had all these increases, or my parent passed away, they never used their policy because they have a traditional. Like, people just don't go on those things. Talk to a professional. Talk to someone who specializes in long-term care and find out about it and figure out if it makes sense for you and your family, and do it early enough because if you wait too long, you might have a health condition that precludes you from applying. And the other thing is it's way less expensive the younger you are. So I would just encourage people as young as possible to just look into it and figure out if it makes sense. I mean, it may not, but if you have a lot of assets to protect, if you've got a child with special needs, so you're worried about leaving money for, if you've got, or I don't know, a lot of us have adult children who, things are going to be pretty tough on the kids who are in their 20s now, as far as AI, as far as just all the different things going on. They're not necessarily going to have an easy time like we did, buying a house or the different things. So, like, if you care about leaving money for your children or grandchildren, if you care about leaving to a charity, at least just find out about it because, you can provide such a nice legacy with the policies. And also, I don't know. I mean, I guess this is not a very romantic thing, but I think it's a way to show love to your family members to say, look, I took the time to put something in place so that you don't have to give up your life to take care of me. You can
Right.
be my companion, but you don't have to be my caregiver. And, to also not have put your spouse in the position of becoming a caregiver and having to do this hard work that is so stressful. So I think if people can think of it as a way to show love and to create the best possible scenario should they need care for themselves, and it's really more for their families than it is for them because the families are the ones impacted. So
Yeah.
just think about it and don't just avoid it because it's unpleasant and think that that's okay. I mean, I acknowledge that it's unpleasant and I'm not debating that, but I just think, it's like, if you wanted to have mobility when you're older, you need to exercise when you're younger. If you want to do well, you got to eat well when you're younger. There are things you have to do today that are hard to make things easier later. It's like I saw a video saying, like, you can do the easy thing today, but then it'll be hard later. Or you can do the hard thing today and make it easier later. And I say do the hard thing now, make it easier later is sort of
Yeah.
where I'm coming from.
Maybe it's easier to do the hard things when you're younger
Eh,
in
well,
general.
right. But anyway, so that's just sort of, just
No, that's
just
great advice.
just to learn about it.
And it really humanizes, the thought behind the insurance. It's not always just the insurance. It's what if you don't have it? What impact does that have on the other people around me that nobody wants to be a burden on their families, on,
No,
other generations of their families, even worse. This is why, we talk a lot about this with clients who have just bought a home, and, you need to protect that home, because what happens if you get hit by a bus tomorrow and your spouse can't afford the house without you, and you don't
right,
have the policies in place? Like, once you own a home, you
right,
have more responsibilities. It's not just the home
right,
itself. It's
right.
the ways that you
Well,
protect the home and the people in it. So I'm
yeah.
I'm right there with you. So,
So,
Suzanne, thank you so much. If people want to find you, what's the best place for them to connect with you if they want to, establish a relationship or ask you a
sure.
question?
Of course. LinkedIn is great, or my website is sgsinsurance.net. Um, but I'm all over LinkedIn, so that's probably the easiest way to find me and message me. And like I think you might be able to tell that I like talking about this topic just a little
I
bit,
I feel your passion. I could talk about mortgages till people go to sleep. So
right?
I get it. I get
Yes.
it.
So I always welcome a conversation, and to be able to. I love having connections in different states, so that if someone calls up and says, I need a care manager in, you know, Timbuktu or wherever it is, I like to be able to refer to other professionals to work alongside me. So
Absolutely. And what
so
states
excited.
do you do business in, Suzanne?
So Maryland is my resident state, but I'm licensed in about 14 different states, and I can add on pretty much any place. So
Got it.
that's not a barrier.
Okay,
So,
fantastic. Well, Suzanne, thank you so much on behalf of the audience and myself. I learned a lot.
oh,
I learn as much from these interviews and sessions as anybody else. So I really appreciate you spending the time to explain all this stuff. It's definitely eye-opening, and yeah, I probably need to make a call. So you might hear from me soon.
oh, yes.
I'm one of those procrastinators because I'm so focused on my own business,
I know.
but I
Well, it
really
feels so,
appreciate.
oh, sure. It feels so good when you can check something off your list, right?
It does. It definitely does, for sure.
Oh,
It's
well,
always
thank
a
you for
long
having me.
list, but
I know, I know. Thank you
for
so much for
sure.
having me. It's great to talk with you, Mark.
Likewise. And yeah, and so for anybody attending live here, our next session starts at 2 Eastern. We're going to be talking about creating your own online community. We've got some amazing speakers who have done just that, and we're going to get into the nitty-gritty details about how they did it, why they did it, the benefits. So it's going to be a really cool session. So please join us. We'll give you about 5 minutes to take a little break, and we'll see you back online in a few minutes. And Suzanne, thank you again
Thanks,
for all
Mark.
your insights and for your sponsorship of the
Of
event.
course.
And we'll look forward to some great interactions with you in the future. So,
Okay, thank you so much, Mark. Take care.
all right. Okay.
Okay,
Take care,
bye-bye.
everyone. See you soon.